Hello and welcome back to the MOONCUM Finance YouTube channel. Today we're going to be going over some crypto terminology. Some of these terms will be very basic and some of these will be, more kind of advanced terms that you don't learn until later on in your crypto experience. But regardless, we're going to be going over them. So the first one we got here is HODL. Now, this can be seen as an acronym, which stands for hold on for dear life, meaning don't sell what you have. But originally it was made by a misspelling on a forum post back in 2013 on Bitcoin Talk. They just misspelled the word hold, and people have kind of been using it in the crypto community as like a meme, and now it's kind of used as an acronym for basically just don't sell, keep holding and believe. Liquidity is our next one. We made a video on this on our YouTube channel. It was actually the last video that we did, so if you want to learn more about liquidity and liquidity pools, you can go check that out. It will be linked in the description. But liquidity is just an amount of money, or like a pool of money, that is available for people to trade their crypto assets for. And when you have higher liquidity, you can make transactions a lot quicker, and it'll be more accurate with estimated funds received. So high liquidity is very good. The halving. So this is for Bitcoin. It's Bitcoin specific, and we'll be making another video going in depth on this, but it's essentially a event where every 210,000 blocks mined on the Bitcoin network, the Bitcoin block rewards are cut in half. So it started back in 2009 at 50 Bitcoin, it halved to 25, halved again to 12.5, and now we're on 6.25, and the last halving happened, I believe, May 11th of 2020. So it's not too far into the halving cycle. We still got quite a ways to go, but we'll be doing an in-depth video on the Bitcoin halving later on, so make sure that you're subscribed to the channel. ATH and ATL, this just means all-time high, all-time low, which is just the highest price that an asset has ever been or the lowest price that's ever been. And you'll see different prices sometimes based off of who is reporting the all-time high and all-time low. So different exchanges will have different prices by, a few dollars or a few cents or whatever. So you just got to keep that in mind if you see multiple different records for all-time high or all-time low. BEP20 and ERC20 are just token standards for the Binance Smart Chain and the Ethereum network. So BEP20 is used on Binance Smart Chain, ERC20 is Ethereum network, and that's basically a majority of the tokens that you'll see on PancakeSwap or Uniswap. A bear is someone that believes the price will go down. A bear market would mean that the price has been going on a downwards trend for a while now. If you're bearish on something, that means that you believe that it will go down in value. And if you're bullish on something, you think it will go up in value. It's just the complete opposite. Bull, green, bear, red. There you go. A whale is a person or entity that holds a lot of cryptocurrency, so a large sum of it. And sometimes the amount can be so large that they can actually manipulate the price of a crypto asset all on their own. Okay, so Satoshi has two different meanings. It's a pseudonym of the Bitcoin creator, so it's like a character that the Bitcoin creator made to stay anonymous. It's also a measurement of Bitcoin. It's, some people say, oh, I have 100 sats or 1,000 sats or whatever, and that basically just means they have 0.000000001 Bitcoin is one sat. So if they have 1,000 sats, then it would be up 3 decimal places. The blockchain, we will make a video more in depth on this as well in the future. This is a peer-to-peer network. There's lots of computers and servers, just different nodes that keep track of every transaction on the blockchain, and it's usually for a certain cryptocurrency or network of cryptocurrencies. So for example, with ETH, it's for Ethereum, the Ethereum blockchain, but there are ERC20 tokens run off of it. So the ETH blockchain also does ERC20 tokens. And so you'll see a lot of different quote-unquote cryptocurrencies, but it's actually just tokens underneath the Ethereum network. If you want to see the blockchain kind of live in action, you can go to etherscan.io or BSC scan, and you'll see like different transactions being made, all the different blocks, the gas fees, everything. So I didn't fully understand the blockchain until I started kind of just roaming around those sites and looking at different things and just clicking on random things and kind of just seeing it all happen. So if you want to kind of learn a bit better and get more hands-on, you should go to etherscan.io and just start looking around. Okay, so a token burn is actually usually a percentage of a token instead of a flat amount, and basically that percentage will get deleted upon transaction. So MOONCUM actually has a 1% burn rate right now. So if I were to send 100 tokens, one token would be burnt. That would be the 1%. And then the recipient will get 99 tokens. So the burned tokens are usually sent to an address called the zero address, so 0x and then a bunch of zeros. And this is an address that people don't have access to. It just kind of goes and is never touched. And so that's kind of the common burn address. And the reason why people do this is so that the value per token will go up if the market cap stays the same or increases. And speaking of market cap, it is a measurement of an asset's total market value. So the market cap is the current price times the total supply. It's as simple as that. It stands for market capitalization. So speaking of the burn and everything, basically if the market cap stays around $100,000, right? And let's say there's 1,000 total supply, 1,000 tokens in supply, that would mean that each token is worth $100, right? And if, let's say, it gets burnt down to 500 tokens instead of 1,000, and the market cap stays the same at 100,000, that would mean that the current price per token would have to double to keep that market cap. And that's why tokens add in a burn function, so that they can hopefully see a deflationary asset where the price will go up over time. A centralized exchange is a cryptocurrency exchange. It's very much like a stock market where there is an authority figure that, kind of confirms everything, and it's not as maybe secure as a decentralized exchange. And a decentralized exchange has no intermediary. There's no central authority. It can be slower than a centralized exchange, but it's often more secure. Our liquidity video that we did recently has more information on centralized exchanges and decentralized exchanges. So if you want to learn that, once again, link will be in the description. A cold wallet is just a cryptocurrency wallet that is offline. The private keys are on the hardware instead of on the internet. So it's a lot more safe than a hot wallet, which we'll get into. But an example of a hardware wallet would be a ledger. It's just a well-known wallet that you basically put your crypto on, and it's just a storage, I guess you could say. And a hot wallet is also a storage, but it's stored on the internet with all the private keys and stuff. So for example, Coinbase or any other exchanges that let you store your crypto on to their exchange, it's a lot less secure, but it's more convenient for a lot of people. Dominance. So this is usually only referred to in crypto trading or when you're doing any technical analysis. And so when Bitcoin dominance is really high, that means that Bitcoin's price is kind of leading the way for the whole crypto market, and altcoins aren't going up as high or as fast as Bitcoin. And when the Bitcoin dominance is down, that's when altcoins kind of start seeing, their big spike and they start outperforming Bitcoin. FOMO is an acronym, fear of missing out. And it's basically when you see the prices going up, and you're like, okay, it's going to keep going up, I need to get in. And you're scared that you're going to lose the opportunity to make money. And so this is actually a bad habit to get into. And it's seen as basically trading off of greed, I guess. So I've definitely FOMO'd into a few trades. So yeah, it's just something to keep in mind. Another acronym here is FUD, so fear, uncertainty, and doubt. And this is when, there's a lot of negative stigma in the market. So when you see news articles that maybe aren't 100% true or biased in a negative way towards a cryptocurrency, people will start selling because they get scared that the article is true. They don't read into it, and then they think, oh, the market's going to crash, blah, blah, blah. But really, it's a little bit of FUD. That's all it is. And at the end of the day, it doesn't change the fundamentals of a crypto project. Fiat is basically just a way to refer to currency that governments accept as legal tender. So like USD, United States dollar, CAD, Canadian dollar, AUD, euro, stuff like that. The flippening is an event that hasn't happened yet. It may never happen, but people say that Ethereum could overtake Bitcoin, and if this were to happen, then this would be called the flippening. Now, for it to pass it, it would need to pass it in market capitalization. So once again, that's total supply times price. Currently, Bitcoin is way ahead of Ethereum, so it might take a little bit if this is ever going to happen. A stablecoin is a cryptocurrency that's pegged to another asset's price. So for example, USDC, that's Coinbase's stablecoin, it is designed to stay at $1, so $1. And this price will never go up, it'll never go down. It's designed to stay at $1. So an NFT is a non-fungible token, and it basically will store data on the blockchain that makes sure that a digital asset is unique and that you own it and that nobody else owns it. And it's usually used in like artwork or videos or certificates and stuff like that. And we might go over NFTs more in depth in the future. We also might release our own NFTs, so definitely stay tuned for that. Gas is basically just the fee of a transaction on a network. So setting your gas higher will bump it up in the queue. So every transaction is placed into the queue. Higher gas makes you go up higher in the queue so that your transaction will complete quicker. And setting your gas lower means that you'll be lower in the queue, but it will cost less. So higher gas is higher cost, but it's quicker to transact. A lower gas is a lower cost, but it's a lot slower to transact, and sometimes might even get canceled because it takes so long. Longing Bitcoin or longing a cryptocurrency just means that you expect the price to go up or that you believe in the project in the long term. So you could be long on Bitcoin just by holding it, or you could open up a long trade on a lot of different exchanges. They offer trading, and so you could open up a long trade, and this would basically mean that you would be in profits if the price were to go up. Shorting is kind of the opposite, where you believe that the price will go down. So if you have a short position, you would basically have an asset, you would sell it, hope that the price goes down, and then rebuy it so that you're buying at a lower price, and you would take the difference as a profit. Crypto mining. So we're also going to be doing an in-depth video on crypto mining because it's been requested quite a bit. But it's basically a process where nodes or computers or servers will do complex math problems, and this is used to confirm transactions on a blockchain, and miners will get rewards for their computing power. So just like how we were talking about the halving earlier, where the miners, the block reward for miners was halving every single time there was a halving event. That's kind of the rewards that we're talking about here. To the moon. A lot of you guys will probably know this in our community, considering our name is MOONCUM, but this is just used kind of in a playful way where you believe or you hope that the price will go incredibly high on a token or a crypto asset or anything really, and you say, okay, let's go into the moon. So it's just a fun little term. A trading pair is a cryptocurrency that gets traded directly for another cryptocurrency, or even sometimes it's stablecoin. So for example, on PancakeSwap, BNB is tradable for MOONCUM, and so that's the pair that we have there. But you could also do BNB for USDC, like a stablecoin, and there's thousands of examples of pairs out there that are being used today. Okay, so our next two terms here are often used in trading. It's resistance, so resistance and support. We'll go over support in a second here, but resistance is used as a term where the price of an asset kind of bounces off of a certain line and won't go any higher than that. So in this image down below here, you can see I drew a blue line, a blue horizontal line, and that is the resistance point, and that's roughly $60,000. This is Bitcoin a while back, and then the red arrows pointing down is where we hit some resistant points at. So we kept bouncing off on those points, and it created a very strong resistance at $60,000 for Bitcoin. Support is just the opposite. Instead of bouncing off and going down, it would bounce off the bottom and go up. So this is for Ethereum here in this example in the image below. And I drew the blue line at around 316 US dollars for Ethereum. And we have two support bounces here on the $316 level. And so we could consider that a support line. A seed phrase is kind of like a backup phrase or a recovery phrase, and it contains a list of words that's used to gain access to a crypto wallet. This is possibly the most important information that you would need for a crypto wallet. So make sure that you keep it safe and that you don't forget it, and also that you don't tell anybody about it. So this term shilling is basically a way of promoting a cryptocurrency where you're kind of overly optimistic and you're trying to boost it as much as possible so that you can gain financially. Slippage is kind of hard to wrap your head around, but basically when you're making a transaction and you expect a certain amount of tokens for a certain amount of dollars, slippage could occur where the price changes while you're doing the transaction, and then you would end up getting less tokens for the amount of dollars that you're paying because the price changes, and then you're not able to get the same ratio. So a slippage percentage is the amount that you would allow that to happen. So our next term here is staking, and it's the action of locking up a crypto asset, and it basically helps sustain a proof of stake blockchain. And the benefits would be that you end up actually getting an interest rate for your stake crypto most often. So it's just kind of like a passive income that you could get. So volume here is just a measurement of all the trades combined, usually measured in USD or BTC, and you will give it a certain time frame. So my example here is Bitcoin's 24-hour trading volume is 103,960,866 US dollars. So that is the volume in a 24-hour period, and that was yesterday that I saw that. And that's pretty much it for our video. We try to make this quick, go over a few terms here and there and just give quick descriptions. Hopefully you get a vague understanding of it. We're going to be launching a page on our website soon called the Classroom, where you can get some educational videos or articles all surrounding cryptocurrency. Also, if you want to download this slideshow, the PDF will be on our site shortly. It'll be in the Classroom link once that's published. And also, if you have any other terms that you want me to go over, just put it down in the comments. I'll try to reply to all of them. And yeah, that's about it. Thanks for watching. Follow us on all of our social medias. Links will be down in the descriptions. Subscribe.